Ondas Inc. stock, trading under the ticker ONDS on the Nasdaq, is currently priced at $9.13 per share, experiencing a downward movement of 1.99% during today's trading session. The stock opened at $8.91, sliding briefly before stabilizing near its current levels, with a daily trading range carved out between an intraday low of $8.67 and a high of $9.18. While a superficial glance at the ticker tape might make this look like a quiet negative session for a small-cap technology company, the real story brewing under the surface completely upends what the broader market anticipates. The big surprise that short-term traders are completely missing is that Ondas Inc. just pulled forward its profitability timeline for its autonomous systems division, expecting to hit adjusted EBITDA profitability by the first quarter of 2027, which is a full 6 months ahead of what Wall Street originally projected. This unexpected shift instantly creates a massive disconnect between the current sluggish stock price and the underlying operational acceleration, setting up a classic dynamic where public perception lags behind corporate execution. When most retail investors look at Ondas Inc., the common expectation is that they are dealing with a highly volatile, highly speculative small-cap entity that survives on empty promises and dilutive capital raises. People look at the massive intraday swings, like the recent 21% spike that carried the stock up to $10.72 in a single session without any immediate press release, and they assume it is just another vehicle for short-term momentum chasers and algorithmic trading bots. This perspective is reinforced when investors look at popular retail trading platforms, seeing high retail concentration and wide bid-ask spreads that make the stock look like a gamble rather than a grounded business. But the contrarian reality is that Ondas Inc. has quietly built a defensive and industrial moat that is starting to secure massive institutional-scale contracts, including a recent initial order of $68 million under a larger $140 million multi-year military engineering program. By looking past the surface-level noise of daily price fluctuations, it becomes clear that the business is transitioning from a speculative tech concept into a highly capitalized defense and infrastructure asset. To truly understand the narrative tension surrounding this asset, we have to look closely at the intense recent market movements and trading volumes that have kept the stock in a state of high friction. Over the past several weeks, the daily chart shows the stock grinding through a wide band, swinging violently between the mid-$8 range and resistance levels just past $12. This incredible volatility is a direct result of institutional chess pieces moving in the background, specifically highlighted by a recent regulatory prospectus filing that registers shares for potential resale by existing holders. When a company registers securities for resale, the initial market expectation is almost always negative because investors fear an immediate supply overhang will flood the market and suppress the share price. This exact fear is what dragged the stock down during yesterday's and today's sessions, causing short-term traders to dump shares out of panic. However, a deeper analysis of the institutional tape reveals that this filing provides liquidity for major strategic backers who are helping fund the company's long-term expansion, rather than signs of structural distress. While the market fixates on the potential for short-term dilution, the institutional volume tell a different story, as accumulation patterns suggest that larger funds are using these macro-induced dips to build positions. The trading volume has spiked significantly on down days, which often indicates institutional absorption, where large blocks of shares are changing hands without causing a total collapse in the underlying equity structure. Sector momentum is also playing a massive role here, as broader technology and defense stocks face shifting macroeconomic pressures, including persistent inflation data and fluctuating interest rate expectations that force asset managers to reallocate capital away from unprofitable growth companies into businesses with tangible assets. Ondas Inc. is caught right in the crosshairs of this macro rotation, as its current lack of net profitability makes it a target for short sellers during days when the broader indexes are under pressure. Yet the company's balance sheet defies the typical small-cap growth narrative, boasting over $1 billion in cash and short-term investments against an incredibly low total debt profile, giving them a massive liquidity runway that protects them from high interest rate environments. Comment below how many shares of Ondas Inc. you currently hold in your portfolio, or if you are sitting on the sidelines waiting for the volatility to settle. To put this balance sheet strength into perspective, we have to look at how Ondas Inc. compares to the broader world of online investing, where retail traders often balance speculative plays against tracking Tesla stock, Apple stock, or Nvidia stock is looking for dominant market leadership with predictable institutional support. Those core holdings form the bedrock of a modern portfolio, often managed through automated tools like Schwab Intelligent Portfolios or various managed asset strategies found across major investing sites. When someone uses a sophisticated online investment platform, whether they are analyzing Fidelity investments to buy Fidelity ETFs and Fidelity mutual funds within a Fidelity brokerage account, or managing long-term savings through Fidelity IRAs, they expect structural stability. The tools available on the Fidelity mobile app and the robust Fidelity trading platform are designed to help investors manage risk by balancing large-cap certainty against smaller, high-alpha opportunities. On the other end of the spectrum, the explosion of retail-focused platforms has changed how volatile small caps like Ondas Inc. are traded on a daily basis. A massive portion of the daily volume for high-swing equities flows through the Robinhood app, where retail participants utilize Robinhood stock trading and modern Robinhood investments tools to chase momentum.
The accessibility of Robinhood Crypto, Robinhood Cash Management, and the ability to buy Robinhood fractional shares has democratized market access, but it has also introduced an unprecedented level of emotional trading volume into small-cap equities. Similarly, platforms like SoFi Invest have captured a massive demographic of younger investors who use SoFi Investing to build holistic financial plans. Whether they are allocating capital into SoFi stocks, diversified SoFi ETFs, or utilizing the automated SoFi robo-advisor, the modern self-directed investor is constantly looking for ways to maximize returns. Through the SoFi Active Investing feature and the integrated SoFi trading platform, retail capital can move in and out of volatile positions within seconds, contributing to the sharp 21% daily swings we see in stocks like Ondas Inc. when a burst of social media attention hits the tape. For international traders and professional operators who require advanced execution, the infrastructure provided by Interactive Brokers Trading offers a completely different vantage point. Utilizing the institutional-grade Interactive Brokers platform allows sophisticated traders to analyze order routing, short availability, and precise market depth. Because Interactive Brokers fees are structured for high-volume execution, this is where the short sellers and institutional block orders typically print their trades. When an account holder opens an Interactive Brokers account to execute complex Interactive Brokers stock trading strategies, they are looking at structural metrics like the short interest rate ratio and the borrow fee rate. For Ondas Inc., these institutional metrics are vital because the stock frequently experiences short squeezes due to its high short float percentage and volatile retail following. When short sellers notice that a company has a current ratio of nearly 4.8 and a massive cash cushion, they know that betting on an outright bankruptcy is a losing proposition, forcing them to cover their positions rapidly whenever positive fundamental news breaks, creating explosive upward price gaps. To anchor this trading behavior in fundamental reality, we need to examine exactly what Ondas Inc. does as a business and how its corporate model is structured. Operating primarily through two distinct segments, Ondas Networks and Ondas Autonomous Systems, the company designs, builds, and deploys private wireless broadband networks and automated drone infrastructure for mission-critical industrial and defense applications. The foundation of their technology is the FullMAX software-defined radio platform, a patented system that enables secure, wide-area broadband communications for large-scale industrial operations like major rail networks, electric utilities, public safety systems, and oil and gas complexes. These industries require absolute network reliability, where a single drop signal could result in catastrophic operational failure, creating a high barrier to entry that prevents standard telecom providers from easily competing. Over past fiscal periods, this network division provided a steady but slow-moving baseline of hardware and software maintenance agreements, establishing long-term customer relationships with legacy industrial giants who are notoriously slow to switch technology providers. The massive growth engine, however, lies within their Autonomous Systems division, which was significantly expanded through strategic acquisitions and mergers, including the integration of specialized entities like Centrix and Mistral. This division focuses on automated data solutions, aerial reconnaissance, and advanced counter-drone systems designed to protect critical infrastructure and military assets. Their product portfolio features highly specialized technology like the Iron Drone Raider, a fully autonomous interceptor drone engineered to physically neutralize hostile small drones without relying on GPS jamming, which can disrupt local civilian infrastructure. They also deploy the Centrix platform, a cyber-based system that detects, identifies, tracks, and mitigates unauthorized drone flights by intercepting their communication protocols. The business model relies on selling the initial high-value hardware systems and then locking in high-margin multi-year software contracts that provide continuous security upgrades, field support, and data analytics capabilities, effectively shifting the company's revenue profile from lumpy capital expenditure sales to predictable, recurring cash flows over time. Looking at the financial history of the company reveals a classic growth stage paradox where spectacular top-line expansion sits right next to heavy operational losses. In previous quarterly reports, Ondas Inc. has demonstrated triple-digit revenue growth over multi-year horizons, climbing to an annual revenue baseline around $50 million. Yet, because they have invested so heavily in research and development, manufacturing integration, and global corporate mergers, their operating margins have historically been deeply negative, with net profit margins sitting well below zero. This past performance created a lingering narrative that the company was burning through cash too quickly to ever achieve self-sustaining operations, causing conservative analysts to steer clear of the equity. But the reality of their recent $68 million military order from the Indo-Earth-moving subsidiary shows that the heavy capital expenditure phase is ending, and the commercial scaling phase is beginning, with physical deliveries of heavy tracked engineering vehicles scheduled to begin in the final quarter of this year. As we look toward the future outlook for Ondas Inc., the trajectory of the stock will be defined by how successfully the company bridges the gap between investor expectations of unprofitability and the reality of their accelerated EBITDA targets. The primary catalyst to watch over the next 12 months is the operational execution of their defense contracts and the integration of their AI-driven mission control software into industrial fleet deployments. If the company can demonstrate a steady reduction in quarterly cash burn while maintaining their triple-digit top-line growth, the market will be forced to reprice the stock based on its forward price-to-sales multiple, which currently sits at an elevated level because the market is discounting their future earnings potential. The major opportunity lies in the global expansion of their counter-drone technology, as international airports, border security agencies, and commercial ports face an established threat environment that requires immediate automated protection systems, placing Ondas Inc. in a prime position to capture market share. Conversely, investors must remain deeply aware of the structural risks that could derail this growth trajectory. The most immediate risk is execution delay. Building and deploying complex military-grade tracking systems and autonomous hardware involve intricate supply chains that are highly susceptible to global logistics disruptions and component shortages. If the initial deliveries scheduled for the end of this year slip into subsequent quarters, short-term momentum traders will likely dump the stock, causing sharp downward price movements. Furthermore, because the company relies on large-scale government and industrial contracts, their revenue recognition is highly concentrated, meaning that a delay or cancellation of a single major program could materially impact their quarterly financial statements. There is also the constant risk of regulatory changes regarding commercial drone airspace usage and radio frequency allocations, which requires the company to maintain ongoing compliance efforts across multiple international jurisdictions, adding to their corporate overhead. When we synthesize these factors, the contrast between expectations and reality becomes the defining feature of Ondas Inc. as an investment asset. The general market expectation is that the stock is a highly volatile speculative instrument fit only for rapid day trading within a retail brokerage environment. The reality is a company sitting on a massive $1 billion liquidity cushion that has pulled its profitability timeline forward, backed by institutional defense orders that provide multi-year revenue visibility. For long-term capital allocators, the current downside volatility driven by technical prospectus filings may represent an inefficiency where the market is pricing in temporary share supply while completely ignoring fundamental operational progress. As the company moves closer to its newly established first quarter profitability target, the disconnect between public perception and physical execution will likely close.